Let's talk about different sectors. Energy, ripe for consolidation?
I think we definitely will on the upstream side. If you look at, just traditionally in the M&A space, energy's represented about, a fifth, in some cases a little bit less of the value of deals, less so in the volume. In the last 18 months, that's extremely depressed. We're now seeing a situation where companies in the energy sector are capitulating. They are being faced with the reality of energy prices. In many cases, their hedges are rolling off. And in the year ahead, we will see many distressed situations. And we will see some core valuable assets that are finally coming to the market. You combine that with the fact on the private equity side, there's been record fundraising in energy funds. There's a significant amount of
And it's almost like a vulture fund, right? Like swooping in to buy distressed assets.
I would say it's a disciplined fund, and it's a very smart strategy. There's a lot of money that's been raised in the sector that's patiently waiting for the right opportunities at the right valuation. So it is not without risk. It is risk adjusted, the returns that they will ultimately earn. But they will have many, many opportunities that are very unique in nature in the months ahead.
You talk about risk-adjusted returns. High-yield bond spreads have moved out to a point, 750, 800 basis points. They're discounting 6% defaults, which is historically very high. Chad, what are technology companies having to do to get more creative or to get these deals done where the financing might be a little bit trickier?
On the private equity side, I think we actually see some deals fall apart in the last 2 months, where some of the most strongest private equity brands we've seen in the technology space actually failed to get a deal done because of financing.
What are you seeing, Alex, on the give back?
One of the things we're definitely seeing is that private equity firms and corporate acquirers are having to be more creative in the way that they evaluate targets and the way that they find value in those targets. Gone are the periods where you assume that the economy was going to be at your back and that operations would continue the way that they had over the recent periods. Now our clients are looking harder at how are they going to operationalize change in their companies, how are they really going to get their hands into the company to create more optionality, to create value. You can't rely on the market to back you. You can't rely on the economy to drive growth and the creation of value in the companies you buy. You really have to do it the old-fashioned way, which is going in, making change, doing restructuring, buying assets that may be a difficult carve-out and standing them up and taking them to market as a standalone business, and doing the hard work of building value in companies.